let's go ahead and get started. We may have a small group, and that's okay. That'll allow us an opportunity to just have a free-flowing discussion. Welcome, everybody. This is the afternoon breakout session. Title is M&A, Getting Your Plans Back on Track. My name is Steve Keston. I am a shareholder with Boyer Miller here in Houston, which is a law firm, and I'd say 60% of my practice is mergers and acquisitions work. So I help companies buy and sell, which is one of the reasons why I wanted to moderate this particular panel. We've got a great panel today. In fact, I think I've either worked with or been on panels with everybody on this panel. So we're all well familiar with each other and have worked together. So we could probably even talk about some of the deals that we've worked on together as part of this breakout panel. Format, if you went to the breakout session previously, then you kind of know what the format is. It's open session. I'm going to ask some questions, sort of facilitate some questions to the panelists. But if you have questions, feel free to unmute your mic and chime in. In fact, we would welcome that because we're looking for this to be sort of a free-flowing discussion as opposed to a strict presentation by the panelists. What I'd like to do to start is to let each of the panelists do a short introduction of themselves, and then we're going to have this breakout session flow sort of in the process of a sale of a company, from understanding the market all the way to, you know, what deal terms should you be considering or worried about in connection with a sale, and some of the legal aspects associated with that. And intertwined with all that, I want to have everybody talk about how COVID has impacted the process, because there's a lot of things that have changed as a result of COVID, not just because of the recession, but tools that have been put in place that are going to have an impact on how you sell your company going forward. So with that said, I'm going to go with how you appear on my screen. And Jason, you're up first, so please go ahead and just introduce yourself and tell us what your contribution is going to be today.
Yeah, so thanks, Steve. My name is Jason Sharp. I'm a tax partner with Briggs & Vcfo. We're a CPA firm here in town. Hopefully you've heard of us. We've got about 300 people. We're here in Austin, the Woodlands, generally do tax, audit, valuation, and as a portion of that, we do quite a bit of transaction work. I've worked with Steve and support many clients on the buy side, and then also many of our clients are the targets of transactions, and so I work on the sell side as well. So being in the tax world, my role is usually going to be trying to structure the transaction in a tax efficient manner, sometimes getting involved in the diligence process. You know, on the buy side, am I walking into a horrible situation with a bunch of unreported taxes, those types of things. And so just working through those issues. And I've been doing this, I always sort of depress myself when I say how long I've been working in tax. You know, I did start in the 4th grade, so maybe that helps. But I've been focused on transactions for about 15 years now. So seen quite a bit of them. And it's funny, I used to work Big Four, and some of those are really big, but I think the small ones seem to have more hair on them than the big ones. So I enjoy the middle market transactions.
Thank you, Jason. George, you're next.
Hey, good morning, y'all. George Puig here. I'm the market manager at Bank of America, which means that I manage a team of commercial bankers. We collectively, from small business up to about the middle market space, we have about $5 billion out to local companies, and it's the Houston area, including South Texas and a little bit of sprinkled in Louisiana. But I mean, our clients range from sole proprietors to middle market companies that are doing $200-300 million. And what we pride ourselves in is helping. We have a lot of companies that have come into our group as 10 and 20 and $30 million companies, and now are 150 and 200 and 270. And we had a healthcare client that we started out with like a $2 million line of credit 5 years ago, maybe 7 years ago. And they grew to a $300 million company with like 30, 40, $50 million in facilities. And then they were acquired by Pfizer. So that's where we are in that sweet spot. We're not large corporate. We're not public. We are, but we're not banking publicly traded companies in my group. And it's not quite the donut shops and nail salons. So it's kind of the core business that we talk to every day. And a lot of them are in transactions, either making acquisitions or we probably have 3 to 4 to 5, just in my team of a dozen bankers, that 3 to 4 to 5 clients that sell every single year. And that's an annuity for y'all, because as folks, baby boomers want to spend more time in Florida and Colorado, that 5 to 6 is going to turn to 6 to 7 to 8 for you.
Great, thank you, George. Brian?
Thanks, Steve. And again, my name is Brian Detman. I'm an investment banker with Truist Securities in the merger and acquisition group. As many of you know, Truist might be a new name, but it's the merger of BB&T and SunTrust. So Truist Securities is the investment banking arm that brought together BB&T Capital Markets and SunTrust Robinson Humphrey. Like I said, I work in the merger and acquisition group there. And from a background standpoint, I'm embarrassed to say, the number of years, we're into 3 decades here. So say 25 years for now, all around middle market M&A transactions. About half of that as an investment banker advisor to middle market companies, either mostly on the sell side or on the capital formation side. And the other half as an investor or owner operator of middle market companies. So I've really kind of spent my whole career in classic privately owned middle market companies and enjoy that. I think someone else had mentioned there's a lot of unique challenges around companies that are out of the public environment, right? And I think from an M&A standpoint, it creates a lot of opportunities and challenges. So as an advisor and formerly as an investor in that, I find that really interesting. So looking forward to our discussion today.
Great, thanks, Brian. And Russell?
So Russell Naisbitt, I am the Houston practice manager for Vcfo. Vcfo is a consulting firm that provides expertise and wisdom mainly to the SMB space, companies 5 to 100 million. We provide CFOs, controllers, and HR specialists to help those companies grow. I did my first M&A transaction back in 1984, so coming up on 35 to 40 years of M&A experience. Altogether, I've probably done about 50 deals. I haven't actually counted them. Working on both the sell side and the buy side. More recently, mostly on the sell side. Deal sizes ranging from $1 million to $2 million to I'm currently assisting a company with a possible transaction that they're in an exploratory phase that could be a $350 to $450 million deal, working with a top 10 Wall Street investment bank. Vcfo helps companies with their transaction readiness, getting everything in order, especially their financial records, preparing financial transactions, and just getting everything on the HR side lined up so that due diligence, which is never pleasant, but can be a smooth rather than a really rocky process.
We're going to get into all that so you can help us with what we need to be doing in order to make it less rocky and more smooth. All right, so let's go ahead and get started. Unfortunately, I don't see everybody's faces, so I can't get you to raise your hands, but I presume that you've joined this breakout session because you're either thinking about buying or selling. And I suspect that, because you are a middle market company owner, that you probably applied for and received a PPP loan. So we're going to talk about all those things in this breakout session. But I think where we should start is, Brian, what's generally going on in the market right now as far as M&A transactions, and what's been the impact of this crazy COVID thing?
Okay, all right. I'll give a little overview. So if we kind of wind the clock back, let's say to the end of last year, beginning of this calendar year, I think that most of us in the deal advisory business would say that the market was very hot, right? Red hot, maybe white hot in terms of volume of transactions and even continued escalating valuations. As we got to, say, mid-March, when COVID-19 really took a hold and it started to impact people's lives, with schools shutting down, offices, moving workers remotely, as you might guess, the middle market M&A and really the larger, broader M&A market really came to maybe not a halt, but definitely slowed down significantly. If you look at the data out there that people have compiled, they range from 60 to 70%. I'd argue in the true middle market, it probably was a bigger decline than that, maybe almost 90+%, at least for a month or two. So kind of think mid-March to maybe, end of May, even into June, things really came to a halt. Unless deals were very late in the process, and we had several, those continued to close, and we did close them in the middle of that, I'll call it that peak of COVID impact. But most deals in process were put on hold, especially in the middle market. And there are a couple of reasons for that. One, I think that buyers looked at their own house and said, gee, what do I need to worry about that's more important than doing a deal? Banks obviously probably got a little bit nervous, you could say, on credit, and probably said, let's just take a pause here. So that tends to slow down the M&A business. Private equity firms, who are large buyers of middle market firms, I think also looked up and poured all their resources into their existing portfolio companies and had to assess, okay, where am I going to benefit from this? Where are my companies that are neutral, and where are my portfolio companies that are going to have big issues? And I think so buyers kind of pulled themselves out of the market in that sense. So things slowed down. If you kind of get to maybe July, August, I think as buyers sort of got their own houses in order and triaged and figured out kind of their own business, I think buyers, and this is capitalism at work, said, gee, maybe there are some bargains out there. And they started to slowly sort of, inquire and creep back into the market, maybe not getting things done. Sellers maybe kind of starting to kind of reassess kind of where they were. And so we've seen activity, go from near zero, if you will, and continue it even through today on a nice upward trajectory. We're not quite back to the activity levels where we were kind of pre-COVID, but we're closer than I would have predicted if we'd had this panel 6 months ago. And so I think I'm optimistic in that sense. There's a lot of things around diligence that are much more challenging today in terms of travel and people being in a room together, doing more things virtually like we are today. We've done some situations where we've done entire deals now virtually, which is interesting. I never thought that was even possible. Or where the on-site diligence is being done with a limited number of people, management presentations, and the bulk of the folks are online. So there's a lot of ways that we have to adjust to do that. But I think from terms of kind of, as I kind of look at kind of where we are, when I look at activity, and that doesn't mean that deals are getting done, but in terms of inbound inquiries around buyers looking to buy, sellers looking to sell, and part of this is, interest rates are really low. Banks have gotten more comfortable, and other lenders understanding the risks of COVID. And these would be in the parts of the market that weren't wildly negative affected, or maybe more so actually benefited from the COVID situation. Those deals, have a good shot of getting done. And I think we're optimistic that we're reaching back to some form of normalcy. Now, there's a whole sector of the economy that is not the case just because of the markets they serve. In terms of pricing, that's a little all over the board. We've seen structure creep into transactions more than what it would have been, let's say, pre-COVID. The smaller the company, the more structure. And what I mean by structure is more contingent payout, more seller risk retention, more buyer hedging, if you will. In particular, obviously, with private equity. And on the smaller end, more of that than on the higher end. And it's always been a natural way to bridge a seller's price expectations and a buyer's willingness to pay. When you get into situations like this, everybody has long memories, right? Sellers remember those big multiples and those big numbers. Buyers think everything's on, for sale at fire sale. Mm-hmm. And structure is a way to bridge that historically. When you have a lot of uncertainty that certainly we're in, it only adds to that mix. Less so on the bigger end of the market, but on the smaller end of the market, that definitely is a factor. And it comes into diligence, and that alone has postponed many deals, right? Whereas sellers look up and, well, if I'm going to keep that risk, I might as well keep the company, at least until we get on more solid ground. Steve, it looks like you were going to say something.
Yeah, when you talk about structure, you mentioned additional seller financing. What other structures are you seeing that are bridging those gaps?
it's, I would say on the smaller end of the middle market, it's definitely more of an earn-out focus, even more so than notes or what I would call financing packages. But I think of an earn-out as a form of financing in a way. It's just a risk-sharing financing.
And if you are, sorry to interrupt, but if you are going to agree, or well, what are you seeing as far as the number? What percentage would you expect a seller to have to potentially? I know it's going to be deal by deal, but just kind of, finger in the wind. Kind of what would be a percentage that a seller should anticipate having to maybe take as seller debt?
That is all over the board. I mean, I have seen historically in the middle market, it's not uncommon to see 5 or 10%, right, of the price be on some kind of seller retention, right? Whether that's an earn out or a note or an escrow or something like that, not wildly uncommon. We've seen structures as high as 50%. Now, I have a hard time advising a seller to take a deal with a 50% earnout. Just personally, I think that's a tall order. It better be a big price, or you better be able to achieve that. But I've seen buyers come up and be pretty creative, and I've seen a lot of sellers say that's not for me. And in fact, that's the case. But it's somewhere in that range, right, where we're seeing. Again, I'm talking about I would call it the lower half of the middle market. As you get into the bigger deals, less so. I mean, the structure is not as common, doesn't work as much, and certainly as you get into large public companies, it doesn't happen, right?
Right.
But that therein, and that's complicated by the fact normally that's based on projections. Well, in the middle of COVID, what are your projections? What is trailing 12 months cash flow? How certain are you? You think about it, it's all about risk. Who's going to retain that risk, the buyer or the seller? And when you're in an uncertain environment, there's downside risk, but I'd argue, think about, there are some companies like grocery stores. Grocery stores in some cases are up 50, 60% in revenue. If you happen to own a grocery store, do you get paid on that 50% uptick? Is that sustainable? So this argument cuts both ways, actually. So it's sort of interesting. And there are other, we have clients that have gone to zero, right, on their revenue just because of the nature of their businesses. So that is another factor.
All right, let's switch to debt, because the M&A markets are driven by debt, particularly when private equity is involved. So private equity likes to leverage their purchases with debt, and the more debt they can get, the higher multiples they can give. So George, tell us about how the pandemic has impacted debt financing for M&A transactions.
Well, we talked about it a little bit on a previous panel and a little bit during the intro here, but as Brian mentioned, banks tap the brakes, right? It's March, April. Banks are trying to shore up their balance sheets, and as we've seen in public filings, whether it's the big 3-4 banks are reserving $5 to $7 billion per quarter for potential losses, et cetera. So this is, we're in an economic hurricane, and we're batten down the hatches. And as we progress through the summer, banks started to dip their toes back into the pool, just like some M&A transactions started to perk up again. And so the entire time at least at Bank of America, I can speak about us, we were taking care of our existing clients. So March, April, May, we were continuing to lend money, but only to existing clients that we had 10 and 20-year relationships with, clients that we know the management team, and we know that they're going through a downturn, and it was an unexpected downturn, but clients that we know have been through cycles and had the balance sheet to be able to weather the storm. And so there was lending, but it was primarily reserved. I think it's across the board for existing clients. And so now the playbook is opening up again, and we're starting to see deals where there's a company A looking to buy company B, and commercial banks are not gonna throw a 50 shot, take a 50-yard shot, ball down the field. It's going to be conservative play calling, and there's going to be collateral requirements, and there's going to be cash flow requirements, and just like the earn-out conversation, there's a lot of risk reward calculations, and a lot of the same logic with whether you do a 10% earnout or a 50% earnout. It's banks are looking at what's the product, how, management team, what's the market demand, what has this done in terms of disruption? Is the client pivoting to digital? So we're thinking about all of those things, and not only historical trailing 12, and somebody mentioned it earlier, not only is it a trailing 12, what have you done in the past, but what's your pipeline for the rest of 2020? How resilient has your product or your service been during this pandemic? And so then we extrapolate that and say, okay, going forward, if they were only down 10, 15, 20% in revenue, that's actually better than the market average. So a lot of balance sheets are replete with cash right now. Clients went and drew their lines, and one of the questions I was thinking about for Brian was, I know there's been a lot of bond offerings out there, high yield bonds, and so I'm curious as a commercial banker if bond offerings have been kind of stepping in and maybe taking over some of the commercial banking. But we are seeing more activity, and banks are supporting companies that they feel have been resilient and have the right business model that isn't falling apart. I mean, if a company's down 50, 70%, they're going to have to go raise some private equity.
So from an M&A perspective, historically and probably still currently, middle market businesses are valued on a multiple of earnings or EBITDA. And then when a private equity sponsor decides to bid on a purchase through a process or otherwise, they likely will leverage with senior bank debt. And senior bank debt in those situations will provide a certain multiple of earnings of debt on the transaction. Have you seen those multiples go down as far as how much the banks are willing to participate in these transactions? How has COVID impacted that, if at all?
Again, I think that the story is about resiliency. I think the multiples can be the same, and in fact, multiples may be expanding a little bit. In particular, there's some really great assets. If there's commercial real estate and some equipment that the bank feels good about, I think banks, at least our bank, we're trying to lean into resilient brand names, resilient companies, and so whereas maybe the historical industry average was a 3 times EBITDA multiple, and maybe it's 3.5, maybe 3.75, but banks are not generally lending 6 times EBITDA multiples unless there's an enterprise value story there. But generally, your Wells or JP, your B of A are gonna be in that 3 something in terms of multiples. So then that delta comes in from the private equity companies, Pocket or Mesdet or whatever. But I think if the story is the right one, banks are actually trying their hardest to lean in, but they're not going to lean in to the point where there's not a story and not the P&L and the balance sheet to support it.
Gotcha. Okay, so we've talked about kind of what's going on in the marketplace, just generally. We've talked about the debt markets. So Jason, let's move into transaction structure. So from a tax and accounting perspective, can you give us some insight and advice on the differences on the type of structures that you can sell your business?
Yeah, I mean, the big question that we always get is, should I sell equity or should I sell assets? And, that's the one where we get to throw out the great, phrase, please consult your tax advisor. And when we're called to be the tax advisor, typically what we'll do is we'll just run a model, take the most recent financials and say, what if we sold the company for $100 and it was equity, or what if we sold for $100 and it was assets? How would that be different? Not to steal your thunder, Steve, you're the legal guru, but for legal reasons, sometimes that will drive the structure more than the tax tail. So, if you have a business that has licenses or permits or maybe contracts that are not easily transferable, we're not going to be talking about an asset deal, because from a legal perspective, acquiring the assets is not going to be that beneficial. They need, those other things, easements or what have you. So that will decide it real fast. But if we're not in that sort of a situation where we have some flexibility, then yeah, you kind of want to run or have your tax person run some numbers and see what the difference is. many times there's almost no difference, if any at all. For example, corporations, you usually see the biggest difference. But for partnerships, whether a person buys assets or equity of a partnership, it's taxed the same. It's taxed as if it's assets, even if legally it's equity. So that,
That's confusing to so many people.
yes, and it is. And but that's just the way the tax rules work. So what happens is it's as if because a partnership is not really considered legally, or for tax purposes is not considered a legal taxpayer. It represents if the 5 of us are partners, we all own 20% of the assets. So if I sell the business, I'm selling my ownership, my 20% ownership in that underlying asset. So that's the way the tax code works. And so really where the reason you get a different tax result in this is it's the tax character of being ordinary versus capital. So capital gain is 20%, ordinary could be as high as 37. So that's what gets the, kind of the rub on why am I being taxed differently? If I can push more of this into that capital gain bucket, then I'm going to get a much lower number. So for example, and not to get too much into the weeds, but if you have a manufacturing company that has a lot of equipment that's been depreciated, and we've had all this bonus depreciation and so forth, and a lot of the value of the transaction is going to be on hard assets, that's probably likely going to be ordinary income because we're going to have ordinary recapture on previously taken depreciation. If I have a service business where, I've got 5 laptops in an office desk and all the value is in sort of the intangible, the client list, the trade secrets, the know-how of the principal people, that's all going to be capital gain. So that's why I say it's important just to work with a tax advisor and just kind of run those models out, because at the end of the day, it may not make that big of a difference, but you want to know that ahead of time, because if somebody comes in and they want to negotiate a deal, you need to know that we can give on this point because tax-wise, we're the same.
So structure matters, right?
Yes.
And with the change in the tax code and the corporate tax rate being reduced down to 21%, we're seeing more and more C corporations when historically it's all been LLCs. And C corporations have a particular advantage if they're retained as small business and are sold in the future. And a particular rule that I'd like you to provide some insight about is Rule 1202, because you can exempt a sizable amount of your gain from tax, and it's not a deduction. It is straight reduce the amount of capital gains tax. So can you tell us about that?
Yeah, so 1202 is interesting, and it's funny. I've rarely seen it. Steve and I actually worked on a deal a few years ago where we had a client who basically sold a business for, I'm trying to remember, it was $7 or $8 million, and it was completely tax-free to them because they jumped through all the hoops of 1202. So 1202 has been around since the 90s. It's rarely been used, but it's getting a lot more attention here lately because, as Steve indicated, the lower corporate tax rate has caused some people to think, well, maybe I don't want to be a partnership. Maybe I can be a C Corp. So again, just sort of backing up, as many of you probably know, partnership only pays one layer of tax. Corporations pay what's known as a double tax because the corporation makes money, it pays tax on it. Then when it pays the dividend out to the shareholders, then they pay tax on it again. So having that lower rate kind of makes the corporate and the flow through potentially very close. So a lot of people are sort of going back to this corporate world. So what the heck is 1202? So 1202 basically says if you form a corporation, so you have you didn't buy the stock from somebody else. You actually formed the corporation. It's always been an active business, assets of less than 50 million. It's a little unclear what happens if it went to 60 for a month and came back down, but for purposes today, just assume it's always been smaller than 50 million. I started it. I've owned the stock. It's never been an S Corp. It's always been a C Corp. We've had it for at least 5 years. Potentially, when you sell that stock, you could exclude a portion, if not all, of the gain. Having said that, I've only seen it work a couple of times in my career. And we've had several people here in the last few years sort of sniffing around trying to see if they qualify. I advised on one transaction last year where we realized the seller, although he owned 100% of the company, 50% of it he had bought from his parents years before. So therefore that's not considered original issue. So he could only exclude potentially 50% of the gain. So it's very detailed. The struggle with 1202 a little bit is, even though it's been around for a long time, no one's really used it that much. So you can get into some gray areas, and there's not a lot of IRS guidance on it because there's not court cases and things like that, just because it hasn't really been used. But to Steve's point, I mean, when you start saying tax-free, you're going to get a lot of people's attention. And it's not something you can do after the fact. I mean, if I've been operating, as a partnership for 15 years, I can't suddenly, easily make a corporation and get 1202. It's something you sort of have to already have the right situation for it. But again, it is incredibly powerful if you can jump through all the hoops.
Agreed. So before we move on, I forgot to mention at the beginning, if you would like, and you have questions for any of the panelists, please feel free to jot them down in the chat, and I'll try my best to direct them to the right person. All right, so we've got what's going on in the market. We got what's going on in debt markets. Now we know what structure we're going to do. Russell, okay, what else do we need to do to plan for and get ready for a transaction? And then I'm going to go back to Brian to talk about what does an investment banker do once the company's ready to go?
So I would say that if you fail to prepare, when it comes to selling your company, transaction readiness is not something that you can achieve in a very short period of time. It's something that you should be, even if you're not planning on selling your company right now, you should still be structuring your company and organizing your records and exercising good practices in your financial accounting and your legal records, filing, keeping minutes of directors meetings, using best practices in HR, and so that when the time comes to sell, there's not going to be any hair on your deal. I would say probably the number one reason that deals blow up, and at least in my experience, and I don't know if the other panelists have experienced anything different, is you get into due diligence and then you find something that's not tying up in the financial statements. Buyers tend to take the view that if they can't trust one number, they can't trust any of them. And the less trust they have in the quality of the information that you're providing, the less you're ultimately going to get for your company. So being prepared is essential, and keeping your house in order at all times is best practice. As you get closer to the day when you're looking to sell, maybe something you might want to consider is getting an audit on your financial statements, or having somebody do a quality of earnings study where they would analyze your business and look at it from a buyer's perspective, looking at the strengths and weaknesses in your revenue flows, looking at your expenses to see the nature of those expenses and whether they're being recorded properly. And so the other thing that is essential to have is a narrative. I mentioned in my introduction that I'm working on potentially a very large deal right now. One of the things that is true, whether it's a large deal or a small deal, is that as a seller, you need to paint a vision for the future of your business. And what you need to be selling is the future and not the past. So I tell my clients, sell the future, explain the past, because you're going to get a whole lot more for the future than what you will for the past. And so part of being able to tell that story is having a set of financial projections that are credible and support the narrative that you're selling. And a good set of financial projections include obviously projected income statements for at least 3 years, ideally as many as 5, depending on the nature of your business as to whether it's possible to forecast out that long. Also a summary of how that translates into cash flow and free cash flow. And I always like to have a projected balance sheet as well, so that it makes it easy then to see, how debt might be deployed in the acquisition of the business that can be layered in easily. I think the other thing it also is to look at your management team and make sure that somebody, especially for a smaller business, a buyer is going to be looking for continuity of management, at least for some period of time, maybe for some considerable period of time. And if you're it, then that becomes a risk for a buyer. So look at how you build out your management team as part of that transition readiness process.
I would add to that, Russell. I think particularly private equity, because their expectation is for accelerated growth after they buy. So they would love to see a management team that has been there, done that before. And you're not always going to be able to get that, but if you have somebody, maybe a CFO who has worked with a previous middle market company that grew to some substantial number and then sold to another private equity, that would be, I think, a plus for your prospects to getting a potentially a bump or a premium on your sale price.
Absolutely.
If I could mention one thing, Russell mentioned the quality of earnings. I think one thing that we've seen a small change in the last few years is for the longest time, the quality of earnings was usually done by the buyer, where they come in and they really do a deep dive and try and find everything during the diligence process. We're now starting to see sellers actually do a quality of earnings in anticipation of a transaction. And I think that goes a long way audited financials are good. Q of E is probably a little bit deeper dive into the operations of the business. And it just shows that you're serious. You're buying some street cred and you're providing this to a buyer, and the buyer may end up reading your report and doing their own Q of E for themselves, and that's fine, but you've gone a long way to help them with that. And the other thing too is when you go through that process, as Russell indicated, it sometimes can be a little arduous. If you go through that process on your own terms with your own advisors, you can sort of see some of the skeletons that maybe you were blind to, and having somebody come in and say, this would be a problem for a buyer. How are we either going to spin this or how can we fix it in anticipation? So getting all of that sort of in a row is sort of like a dress rehearsal for due diligence. And so for the longest time, sell side, no one liked them here in the States. They started doing them in Europe years ago, but we're starting to see that now where that has some credibility.
So sometimes sellers get unsolicited offers. There's a strategic in the industry, so they might get a call or an email from a prospective buyer. But Brian, I know that's not always necessarily going to get you the best price, and engaging a investment banker may be the right answer. So can you tell us a little bit about the process of engaging and what does the investment banker do for the seller?
Sure, happy to do that. And it's funny when you ask that question, everything I say is going to sound self-serving, and it's not meant that way, but it is. And, a lot of companies do get unsolicited offers. Some of those are real. Some of those are maybe more a stretch. Sorting that out is not an easy task. If I think about why would you hire an investment banker, and investment bankers don't work for free, so there's an inherent cost in having that. There's probably two main themes, and I'll hit those high and then I'll come back to some detail. One is the concept of process with a capital P, and I'll come back to that. And the other is competition. And the concept there is it's very difficult to get the highest price and best terms if you don't have a competitive environment with buyers. And buyers meaning you really got to have at least two to have a horse race. And so as I kind of step back and unpack all of that, there are kind of three parts to a transaction, if I really kind of lump it broadly. There's preparation, there's marketing, or I'll call it execution, and then there's closing. And a lot of folks, want to take a shortcut, right? And there's some attraction to that, right? You get an inbound call, it's somebody, even if it's someone you know or a competitor, and they're credible. You say, wow, I can keep this really quiet. I can do this quickly. I'm smart. I can get to a price. I've negotiated hundreds of thousands of contracts in my career. I can get this done. And that's probably true, but you're probably going to leave money on the table or terms on the table or have a certainty of close that's something less than acceptable. One of the problems with a one-off negotiation is that you really get to a point where you have, as a seller, have to make a binary decision. And it's either I accept the deal that the buyer ultimately gets to, or my only alternative is to say no. I think that's a bad place to put yourself in. And so by running a process and creating a competitive, what we call auction tension, and doing this in an organized fashion, you always have a backup plan, right? You even if you only had 2 bidders, right? You've always got a backup person that you can go to instead of saying no or accepting a suboptimal deal. So kind of keep that in the back of your mind if you're tempted to sort of take a shortcut. The other thing that is unique about the middle market is many, and I would argue most of our clients and most of the middle market that's owned by families or entrepreneurs or even partners that might have worked together, is that it is a significant portion of their net worth. In many cases, not just 50 or 60%, but 70, 80, 90% of a person's net worth. This is not the time to cut corners and try and save a few pennies, right? It is really pretty mission critical, once in a lifetime. So I kind of, we have a phrase, and one of my partners loves to use this, train hard, fight easy. And that kind of gets into this first part around prep and whether that's doing a quality of earnings on the sell side as opposed to letting your buyers do it. This is where another part of I'll call this an administrative role of an investment banker, is organizing all of your material, getting the story straight, identifying problems in conjunction with your legal counsel and with your accountant. What are buyers going to have problems with? And we can help you figure out how to address those. Or if they're insurmountable, let's not even get out in the market, right? And we'll figure out a way to do this 6 months or a year later. But usually you can figure out ways to deal with it. Then launching into an organized process of marketing the company. And that could be narrow, it could be broad, we'll figure that out together. But also only doing that with qualified buyers. Even if there are inbound folks, they can be at the top of the list, but they need to know there's competition. That's a critical part about the marketing process. The other question I ask my clients when we have this discussion, or prospects, is if you're bidding, let's say you make widgets and you've got one case you're the sole supplier of these widgets, and the other case you're competing against 5 of your biggest widget manufacturer competitors. Do you price that product the same for those 2 situations? And they all laugh at me and say, of course not. Well, when you're dealing with a buyer one-on-one, do you think you're going to get his best terms and price? That's number 1 issue. Number 2 is the certainty of close. Because your alternative is say no, he can drag you on a long time to his benefit. I'm not saying that's their intention as a buyer, but they have that optionality that you give away when you don't have a process. And then probably the next sort of third phase is the closing phase. Once you do select a buyer and sign a letter of intent and you go exclusive, now time, as in many cases, is your enemy. You want to get this thing closed. Here's where you really can, having an investment banker, keeping some pressure on that with your cover bidder, with other competition, keeping that guy moving through diligence and getting that thing closed. That is really hard to do because most sellers have a day job running their company, right? And so it is, there is value add all along the way. And again, I know that sounds sort of self-serving, but when it's this significant a portion of someone's net worth, it's a complicated world. Buyers are really good at what they do, especially sophisticated buyers. They do this every day, and most of our clients do it once or twice in a lifetime. So those are kind of the main themes that when I'm chatting with clients, helping them understand why would you hire an investment banker, and again, no, it's not free, right? There's a cost. If we're doing it right, that should not only pay for itself, but many times over.
Thank you.
Can I just jump in there to affirm
Sure.
what Brian was saying and maybe illustrate it with an anecdote? So I think putting a quality deal team together, which would include investment banking, legal, CFO support if you don't have experienced support in-house, tax advisor, and getting your bankers involved is critical. And to illustrate that, the importance of running a process, I was involved in a deal a couple of years ago. It was a software company. They'd reported, in the first 6 months of the year, they'd reported $800,000 of revenue. And we're projecting to grow that to around $2 million for the full year. They received some unsolicited inbound attention. They engaged with an investment bank. The company that was looking to buy them was one of their partners. They OEM'd their software to them. It had become a critical part of their much larger product, but it was driving sales for them. So they wanted to buy this company. They also OEM'd their software to another publicly traded company, which was the major competitor of Company A. The investment bank set up this auction type process. The bidding started at $23 million. This is for a company that had a $800,000 for the last 6 months. The sale ultimately closed at $40 million. Now that was structured where they got a little over 30 million down, and then there was close to a $10 million earnout. But potentially $40 million for the owners of the company. And so, in that case, the amount that the investment banker got closed at the closing call was peanuts compared to the value that they added to the process by, and they were brutal in playing these two parties against each other, to the point where they actually had 2 stacks of completed documentation ready to sign, and they could have chosen either deal. They ended up on a Thursday notifying the winner. Saturday morning, let the loser know, and they closed the following Monday. So that's how they ran it right down to the wire.
That's a crazy story. That also could lead to a whole nother discussion, which really would be for a whole nother panel on valuation. Why did that company get in essence, a 40x? When other companies are getting 3 or 5. So, but we're not going to go there. I'm not sure we have time for that, but maybe we can come back to it in the last couple of minutes. But what I wanted to share real quickly to the group is, the impact of the PPP loan on the M&A process. And, PPP has been the hot topic for the last 3 to 6 months now, and it's going to continue to be a hot topic for the rest of 2020 and most of 2021, because there's really no particular incentive or push to get forgiveness applications into your bank. The PPP loan on your balance sheet, if you're a seller, is going to complicate your transaction. And it's even more complicated if you came late to the game and got your loan, say in July, because your covered period, which is the period in which you can deploy your PPP loan proceeds, continues for 24 weeks. And if you sell your business during that period and you haven't applied for forgiveness yet, there's all kinds of complications. If you sell your equity, then you've got to get the bank to consent to that transfer of that loan. If you are selling more than 50% of your business and you're not going to create an escrow with the lender of 100% of the PPP loan proceeds, then you've got to get the SBA's consent for that change of control. And timing for that is going to be completely uncertain. And then another really interesting and scary result of the PPP loan, if you're in your covered period and you sell your assets to a buyer, typically when you do that, you fire all of your employees and the buyer hires those employees. And under the forgiveness rules, if you terminate employees, you get a proportional reduction in the amount of your eligible forgiveness. So if you go from 100 employees prior to the sale, fire them all, the buyer hires them all, you've gone from 100% to zero. You have zero opportunity for forgiveness at that point. So make sure that you've talked with your lawyer about your PPP loan in connection with the M&A process, because there's a ton of complexities and there might be some creative structuring that you'll need to do if you are currently in your covered period. I will then ask Russell if you wouldn't mind talking a little bit about some of the deal terms sellers should be thinking about or being prepared for relative to selling their business, because you've sold multiple businesses as the chief financial officer of the sellers.
Yeah. So so the things I always look for in the deal, obviously the price is important, but the terms are just as important. Is a bird in the hand worth two in the bush? So am I better to take a higher upfront cash for the business, or should I take less cash but potentially get more ultimately on an earnout? And the answer on all of those things is it depends. Other things in terms of looking at the deal is looking at the reps and warranties and any associated indemnities, really looking at potential exposures and how to mitigate those. And there are a number of ways that that can happen from both from a legal point of view and a structuring point of view. It's I'm saying rather than try to negotiate those things out, oftentimes sums are set aside in escrow accounts against contingencies and that kind of thing. One that a clause that's probably going to pop up in most, by far the majority of deals, is the net working capital adjustment. So buyers, when they buy a business, they're expecting a balance sheet, typically no cash, no debt, and a certain amount of working capital based off of the historical averages that are required to sustain the business. That's an area where tricks can be played. I've seen tricks played there. So you need to consult with your financial advisor on that to make sure that the target net working capital is correct, and the basis of the true up is also well defined. And
that is certainly a very confusing element for sellers, because a lot of sellers come to me and say, hey, right, I get all the cash, I get to sell all the inventory before we close, and I get to keep all the receivables, right? And no, the answer is no. You go, but wait a minute, those are mine. Well, yeah, they are, but they're not, because your business was valued up on a multiple of your earnings, not on your receivables and your inventory. And when the buyer buys the business, they want to make sure that there's enough working capital in order to run the business when they get it. So it's confusing to sellers, and then the actual mechanisms and the adjustment mechanism is super complicated.
And so those would probably be the main things that I would advise sellers to be aware of. Other things will be everything's every deal is unique. But I would just again emphasize the earlier point of putting together a deal team so that you are advised by an attorney that has done this before. You have an investment banker in your corner, and you have somebody, an experienced financial person who has been involved in several M&A deals. So because you can bet that the people on the other side of the table have probably done it before, and they know the tricks.
So George, we've got about 3 minutes left, and I'm curious as to what your experience has been with pricing, interest rates. Has interest rates gone up as a result of COVID? And what's your projection for the future?
Yeah, we had a pretty good sized middle market company reach out to us early on in COVID and say, well, gosh, the Fed dropped rates down to 0, and so your cost of capital is now 0, and so you should be lowering our interest rate, right? And so we put together some market data, some bond offerings, some public filings of companies in the same industry, and we said, look, your pricing is right in line with a $3 billion company in your industry, so you're actually getting a really good deal. We ended up increasing the rate on that particular deal because their risk profile changed. But cost of capital is higher in today's environment because there's a higher probability of default. But that doesn't mean that the capital is not available. So at the end of the day, if it's a LIBOR 300 deal instead of a LIBOR 250 or 225 deal, but there's access to capital, then I think the majority of business owners would be happy to take that on if it helps them continue to accelerate growth. I was going to add one quick thing about one quick point about some of the M&A conversations we've had, and that is, as a banker, it's really helpful for a CFO, for a client to work on add backs and to have add backs. And sometimes there's stuff that especially privately held companies tend to expense rather than capitalize. And so at the table with a acquirer, you know, there could be the conversation about $1 million worth of add backs that they're negotiating. So quality of earnings, that's a really great exercise for the potential seller to go through that internally and work on that. And is it the right story? I'm not even talking about our one client who put $400,000 of a wedding expense as a marketing expense. Not even talking about that one, but getting that nailed down can help with that multiple.
Thanks, George. I think we're out of time. And I wanted to thank the panelists for a great discussion. I think this was terrific. And thanks for the audience for attending our little breakout. So as Russell and Brian said, you know, if you're going to sell your business, make sure you've got the right team in place, and you're looking at them right here, all 4 or 5 of us. So if you need our assistance, you should have our information in your packet that was sent to you with regard to the program, and you can reach out to any of us, and we'll be happy to talk with you about our particular expertises. So with that, I think I'm going to conclude our session, and I'm looking forward to our lunch speaker.
Thanks,
Hi,
everybody.
everybody.
All right.
Great.
Thanks.